Good day, everyone, and welcome to our seminar on the state of the markets for March. It's been quite a busy month. We've had quite a lot going on since I last spoke to you on the 7th of February. Of course, the big news for South Africa is the advent of Cyril Ramaphosa as our new president. That has unleashed a wave of optimism. And optimism, I think you could say, is the most important factor in any economy. Because when businesses and consumers are optimistic, they spend more, they invest more. So we're going through a sort of a honeymoon period, you could say, similar to what happened when Nelson Mandela took power in this country. And of course, that honeymoon period is further boosted by the fact that the world economy is really starting to grow, particularly America. Overseas investment is pouring into this country, and you can see that from the stronger rand. Obviously, one of the initial benefits of that is the drop in the petrol price of 36 cents. That is really entirely due to the rand's gains against the US dollar. Mr. Ramaphosa has started off at a great pace. His first endeavor was to change the board at Eskom, and now we've got a new CEO there, Hadebe, who's got a great track record, and he's busy refinancing the Eskom debt, cutting costs, and obviously his objective is to bring the horrendous debt position at Eskom under control. That, I think, was the greatest threat to the South African economy, and Ramaphosa didn't waste any time dealing with it. And the next thing that he had to deal with, of course, was the Ministry of Minerals. He got rid of Zwane and he's put in Mantashe. And Mantashe is a notorious yes man in the ANC. He will simply do what he's told. And what he's been told to do is to get the charter, a new mining charter, agreed with the Chamber of Mines out within 3 months. That's quite an ask, but I'm sure he will achieve it, and you can be sure that that new charter will be very investment friendly. In fact, it is now estimated that the amount of investment, mining investment in South Africa this year, 2018, will be double what it was last year, purely because of the optimism. And that, of course, will create thousands of new jobs for South Africans. Of course, one of the negatives of Ramaphosa's election is this whole question of expropriation without compensation. And that is obviously a very delicate point, and it has done some damage to his image with overseas investors, but not a great deal. My take on this is that Ramaphosa, his intention here is to cut the ground away from Julius Malema and the EFF. I mean, this expropriation without compensation was Julius Malema's strongest point, and now Ramaphosa has made it the ANC's point, and he's busy taking it along the path to implementation. And by doing that, I think he has basically cut the ground away from under Julius Malema. Of course, he's also busy cutting the ground away from the DA, because everything that he does, like his appointment of Nene as the finance minister, adds to his popularity in this country with DA supporters. Even though it was the ANC that put in the wrong person there in the first place, he is benefiting from correcting previous ANC errors. And I think that will continue until the election. And of course, this has forced Malema to move significantly to the left. He's now starting to make radical, populist remarks, which are very racist in many cases, and some of them are just quite honestly not practical. Like, for example, he suggests that all the land in South Africa should belong to the government and be rented out to private enterprise. That is never going to happen. So Ramaphosa has forced him into the sort of lunatic fringe on the left-hand side of politics in this country. He's starting to sound more and more like he used to sound like when he was running the Youth League so many years ago. And of course, if you want to know what's really going on behind the scenes, the rand is the key to all this. The rand discounts all these political events. And I've explained this before, but I'll just go over it quickly again. International currency speculators are very keen on the rand. It's one of their favorite markets because it's very liquid, trading over 50 billion rand a day on most trading days. And they like it. They can get in and get out whenever they want to. And it's a very fluid market. But they are investing literally billions of US dollars. So it's not unusual for them to pay a lot of money to get exactly the right information. They clearly want to know what is going on. So if you see the rand strengthening, it is because they are positive. And they are positive probably on the best sources of information available in South Africa. So when I want to know what's going on, I look at the rand. Whatever is said in the press, whatever sensationalism comes up, is not really relevant to me. I watch that rand very, very closely. And you will have noticed that as a result of the expropriation issue, the rand dipped a little bit, yes, from 1151 to about 1180, around there, and it has subsequently strengthened, but really you cannot say that that is a major issue in terms of the rand and the strength that it's been going through. Let us just quickly look at that. I'm just going to go to the rand chart here now quickly. So there we go. Now you can see what I've put on the screen here is the new strengthening channel, which is picked out by 2 points on the top channel line and 2 points, almost 3 points on the lower channel line. You can see here this little blip here on the right hand side. That is the weakening of the rand as a result of the land expropriation issue. And you can see it's already started to reverse that. And really in terms of this strengthening channel, that little blip there is not significant. I'm expecting the rand, in other words, to continue within this channel. From a technical perspective, looking at it from a charting point of view, it's interesting that these two channel lines are virtually parallel. How can you explain that except by saying that technical analysis works? In my opinion, every private investor has to do technical analysis because he will never have all the information. Nobody that I know of, even despite however much research they do, will know exactly what's going on in the political arenas of this country, and so they can't know all the things which are affecting the rand. So the best thing to do is to look at the charts and see what the big guys are doing. All right, let's have a look at the economy. The economy is now recovering. The South African economy is what I call a light switch economy. What I mean by this is that it's either off or it's on. And basically it's been off ever since the 2008 subprime crisis. Now, with the advent of Ramaphosa and improving commodity prices, suddenly it's on again. And everybody's out there spending, everybody's optimistic. Funds are pouring into this country for various investment projects. The rand is getting stronger and stronger, and it's generally good. The light switch has been turned on. There's no more powerful force, as I said, in an economy than optimism. And of course, Cyril Ramaphosa got the budget sorted out. I know that Gigaba gave it, but he certainly did what Ramaphosa wanted him to do. You can rely on the fact that that 1% hike in VAT and the 85 billion rand in spending cuts were motivated by Ramaphosa, and Gigaba just simply did what he was told to do. The 85 billion rand in spending cuts was taken mostly from the provinces. And that will impact on the construction industry, but the construction industry is already in a very depressed condition and doesn't really rely much on government contracts any longer. The VAT hike will have an impact on inflation, but not a great deal of an impact, because remember, 40% of the products in South Africa that are sold in South Africa are VAT exempt. And those are obviously mostly the products which are bought by the lower income groups. Of course, there is the negative of the higher education legacy from Jacob Zuma. We're going to be spending 57 billion on that. But of course, that 57 billion is taken over 3 years, and this year, 2018, only 12.5 billion will go to provide free education for certain groups of students, tertiary education. The next step facing Ramaphosa, of course, is to reduce the size of the government. And the best place to begin with that is to cut down the number of ministries and ministers. We have definitely a bloated ministerial position. We could do with probably half the number of ministries that we have got at the moment. And then, of course, a commensurate reduction in the size of the civil service. All the ratings agencies approved of the budget. So there will be no further downgrades. And in fact, this has opened the door for possible upgrades. The 85 billion that we're saving on spending will obviously mean that despite the 57 billion for higher education, the budget is net positive. It consolidates. It reduces government debt, not increases it. And of course, you mustn't forget that the budget is based on an expected growth rate of 1.5% in 2018, this year. That is incredibly conservative. Most of the economists are talking about anything between 1.9% and 2.3%, and I personally think it will be above the upper end of that. In other words, I'm expecting anything from 2.5% upwards. Now, if it is more than 1.5%, of course, it will make the budget look very much better in due course. The budget will come in far better than is projected. And I think that's what Ramaphosa is looking to do. He's looking to bring only good news, to say we did better than we predicted. The cabinet reshuffle was of vital importance. We've now got Nene back and Mantashe in charge of mineral and mining resources. So those are vital changes which needed to be made. The commodity prices are rising. We made a 15 billion rand trade surplus in January, largely because of stronger commodity prices. And that, of course, in turn, is being pushed by the international recovery of the world market. People are demanding our raw materials. Also, retail sales were much better than expected. Real incomes are up 2%, mainly because of the very low inflation rate in this country. Inflation has come down to 4.4%. It's well within the target range between 3 and 6, and it looks like it may fall further. Of course, a lot of that is to do with the end of the drought. Food prices have come down, and animal feed prices have come down, and that is helping consumers in South Africa a great deal. Okay, let's turn our attention to Wall Street now, quickly. Just see if I can pull the S&P 500 up on the screen here. Of course, Wall Street is in the middle of a correction. Here you can see it on the right-hand side of the chart. It came down very sharply, about a 10% correction. But it happened very, very quickly. And now it seems to be recovering already. In other words, what we're looking at here is a higher low. And that's always a bullish sign. Of course, the reason for this correction is really twofold. The underlying reason. Firstly, the markets went too high too quickly. You can see here how this rapid acceleration in the S&P 500 was clearly unsustainable. And I actually said that in one of the articles a while back, that we could not expect this to be sustained. Some sort of correction was inevitable and indeed healthy. So now we've come off from that high point, and the market found a new bottom here, just below the upper channel line, the long-term upper channel line, then bounced back up again, came down, touched that channel line, and has bounced off it. So you can see the channel line is actually quite important in the analysis of the S&P 500 and what is going on there. We said right at the beginning when the correction first occurred, we said it last month in last month's confidential report, that this was just a correction. It wasn't the start of a new bear trend, and therefore it represented a buying opportunity, and that you should take the opportunity to pick up JSE-listed shares which had offloaded for one reason or another, but particularly because of Wall Street. Of course, this correction is also caused not just by the acceleration of Wall Street, the excessive acceleration of Wall Street, but also because investors, seeing the positive news which flows out of the American economy virtually every day, became very concerned that the Federal Reserve Bank would increase interest rates there, or would increase interest rates more rapidly than they had predicted. And so we have this paradoxical situation where the stronger the economy is, the more the Wall Street investors get nervous and the bigger the correction. But in my experience of this paradox, usually after a few days, you'll get some more positive news coming out of the economy. People will forget about interest rates and the market will start to go up again on the back of one of a number of things. That could be better housing starts. It could be higher job rates and lower unemployment, those kind of things. And it could, of course, be better profits coming out of the S&P 500 companies. And we'll talk a bit more about that in a moment. Of course, into this fear of rising interest rates, Donald Trump waded in with his trade war against China, his suggestion that we should raise the price of steel with a 25% tariff in America and aluminium with a 10% tariff. So these are radical and, quite honestly, insane suggestions that will cause a trade war with China. So you would then have the two largest economies in the world busy cutting out each other's imports and preventing the other from exporting to them. And that is not in anybody's interest. That will have a cost for everyone. And Wall Street, of course, doesn't like that because that will have a cost for Wall Street companies. But I don't think it's ever going to happen. I think it's like many of the things that Trump has said and has not been able to put into practice. So I think it will wear off fairly soon. More good news will come out from the economy, and then the markets will recover steadily from this. But you mustn't forget the correction is not yet over. I stress that. The correction is not yet over. And it will not be over until we make a new record high. And that could be a month away or 2 months away. But I do not think we're going to languish in this correction for very long. So if you want to take advantage of it, choose your share, choose your moment, and get into the market. Now, in America, the forward estimates of the S&P 500 companies' profits for the fourth quarter are $158 a share. That is a huge improvement on the previous quarter, and it puts the stock market, or the S&P 500, on a price earnings ratio of 17.5, which means that it's not overpriced, it's not expensive in terms of the earnings of the companies which those shares represent. And the price earnings growth ratio, which we have discussed in previous seminars, and which, if you don't understand it, you should go and read up on it. We do have lectures on this, and you can go and take a look and see what it means. But the price earnings growth ratio of the S&P 500 companies is just 0.87. And you may remember from when I discussed this in detail a little while ago that anything below 1 is cheap. So 0.87 means that the S&P 500 is still cheap and it has some upside potential. All right, so much for the markets, both local and international. Let us now look at some companies. So the first company I want to look at is Capitec. Capitec Bank. Of course, Viceroy came out with their report on Capitec since I last spoke to you, and they were riding on the success of their Steinhoff report. People were nervous, and the Capitec share fell dramatically, fell about 25%, in fact, from the highs which it reached. And the interesting thing is that despite the debunking of that Viceroy report, and many analysts saying that it was not well formulated and thin and so forth, nonetheless, Capitec shares have remained at a significant discount. And even now, they're trading around 850 Rand a share, well off the peak that they reached, which was almost 1,100 Rand a share. Some people have said that this formation down here is a bear flag. I don't agree with that. I think it's actually trending upwards here. There's obviously support here at 800 Rand. Very strong institutional buying and support there. But the share is, in my view, trending up steadily. And I think that it will recover. What is interesting about Steinhoff is that it's on a price-earnings growth ratio of just 0.63. Now, you mustn't forget that anything below 1 is good value. So 0.63 is very good value. And it's far cheaper in terms of its historical earnings than either FNB or Standard Bank, both of which, of course, are trading on much lower price-earnings ratios. And there's a lot of institutional buying of this share. If you go and have a look at the SENS, you'll see it's dominated by purchases by the directors or associates of the directors and other companies, major purchases of Capitec. So I still think that the share is good value and will probably rise. But that doesn't mean you shouldn't have a stop-loss strategy, of course. The next share that I want to look at is Sibanye. Now, Sibanye is run by Neil Froneman, and it has been in a downward trend for a long time. There you can see. It reached a high over here of about 70 Rand, and that was in August of 2016. Since then, it's been moving down, moving down, moving down. And you can see where it is right now. It's down here, right? So today it was trading at 12.50 Rand, around 12.50 Rand a share. Now, the reason it's down there is because institutional investors are very nervous about the amount of debt which Sibanye has accumulated. They have been on a very aggressive acquisition trail. They bought Stillwater Palladium Mine in the United States of America for $2.2 billion. And now they've recently bought Lonmin, mainly for shares. The reason they wanted Lonmin was for its smelters, primarily. But their balance sheet, the balance sheet of Sibanye, is definitely stretched. They've got 23 billion Rand in debt. But what we can't deny is that Neil Froneman had the courage to buy all these precious metals mines right at the bottom of the cycle. His purchase of Stillwater is amazing. He got it right at the bottom of the palladium cycle. So he's paid very good prices for these things. Now the next task that faces him is to reduce this huge debt of 23 billion Rand. He must get that debt under control. But if he is right, if he is correct, and he bought these mines at the bottom of the cycle, and precious metals now start to take off, Sibanye will be one of the best investments that you could make. Of course, there's high risk here. There's high risk because you're in a commodity. But I have very strong faith in Neil Froneman and his team, and I think that they can make a success out of these mines which they have. They will be one of the biggest mining operations in the world if the commodities prices continue to go up. The next share that I want to look at is a company called Master Drilling. This is a JSE-listed company. It operates in 20 countries around the world, and they specialize in drilling holes in the ground. That's what they do. Up till now, they've been drilling vertical shafts for mines. So if you want a shaft 6 meters in diameter, going down 2,000 feet, these are the people that you phone. What is interesting about this company is that they have recently developed a new technology, a new kind of drill. And this new drill, does horizontal shafts. Now, you may not know this, but most of the shafts, about 90% of the shafts in a mine are horizontal. Only about 10% are vertical. So you drill a vertical shaft going down, and then off that shaft you have horizontal shafts, right? And those shafts are obviously where you're going to go in order to recover the ore. So they've developed a machine which is operated by 3 people that can dig these horizontal shafts 3 to 4 times faster than current methods. The current method is you put a team of guys down there, they drill holes in the rock, place explosives, blow it up, go back, clear the rock out, and then they repeat the process. So this machine can drill a horizontal tunnel 3 to 4 times faster. And it only needs 3 people to operate it. And in fact, they are working now on a fully automated version. So there will be no people by that machine. It will be operated by an operator who is sitting in an office on the surface. He will be operating it through visual reality. Now, if they do this, if they are successful with this, and they say that by the end of this year they will be in production of these things, this could revolutionize deep level mining in South Africa. The other thing about this machine is that you can tilt it downwards or upwards at an angle of 12 degrees. So it can be used to go and find other ore bodies and to change the position of the shaft. Anyway, what's interesting about it is that there you see it there, and we think that this share has got some potential. So go and take a look at the share and give it your attention, because I think if you want to capitalize on the disruptive technologies in the mining industry, this would be one of those technologies. Okay, now I want to look at Resilient. Now, Resilient is a REIT, a real estate investment trust, and it has been very much in the news because it has various sister companies. It is connected with Nepi Rockcastle, Green Bay, and Fortress, all of which are listed on the JSE. And the reason it's in the news is because a company, an asset management company called 361, produced a report which was very damning about Resilient. And we understand that they went short on the share at the same time. Now here you can see how the Resilient share price just tumbled. It was 151 Rand at this high point here, and it's really tumbled all the way down, and it's now trading just around 60 Rand. Now, this was one of the darlings of the stock market before this report came out, and now it's lost more than half of its value. So you've got some of the best real estate assets inside South Africa, and more importantly overseas, in Poland and places like that. And you're getting them for half of what you would have had to pay for them as recently as December last year. So in that few months, the shares just tumbled based on this report. Now, of course, management have said the report is nonsense. They've been accused of using these 4 listed companies to buy each other's shares and so manipulate their share prices to these extraordinary levels. They deny it, but the shares continue to fall. Now, for a person who's a private investor, this sort of thing always represents a bit of a quandary, because how do you know what's really going on? Maybe there's truth to the report, maybe there's not. All you can see is what is going on in the market, but that is why you need to use technical analysis. And in a situation like this, where you get a high quality share that does a significant fall, and that seems to be happening once in a while here on the JSE, then you should use a 65-day exponentially smooth moving average. You can see I've put that on here, and it follows the market very much more quickly than a standard moving average, because it is exponentially smooth. The most recent prices have a much greater impact on the position of the moving average than the older prices. So it follows the market much more closely. And what we recommend is that you wait until you see the share price, which is way down here, break up through that exponentially smooth moving average. Because in our experience, these things take a little time to work their way through the market. So you'll get a lot of backing and filling, some sort of bottom formation occurring. And then finally, you'll get a break upwards if the share is going to stay in business. And at that point, the exponentially smooth moving average will have come down until it's very close to the current market price of the share. So you will probably get in at the absolutely the best moment. We just find that the 65-day exponentially smooth moving average is very good for this particular situation, where you've got a sharp fall off in a very high quality share. Then you can wait until everybody, all the insiders have finished doing what they're doing, And while you're waiting, if the share then collapses again, you're not in it, so you don't have to worry about that. It will just be cheaper. And while you're doing that, you can follow on your share friend where the 65-day exponentially smooth moving averages. I mean, if we go back over here to January of this year, you can see here that if you look on the little screen on the left there, you can see that the exponentially smooth moving average, which is the bottom of that screen, was at 141 Rand per share. It's now fallen to 106 Rand per share, and I think it will fall quite a long way further. So that figure, that 106 Rand, is what you would, that is the most you would have to pay for the share now. But it comes down by a Rand or 2 Rand every single day as the share wallows at these low levels. Now, another example of this, of course, is Steinhoff. So let's just take a look. I've got to get out of that first. Close that. Let's just take a look at Steinhoff. This share also, of course, has fallen heavily. And I want to show you the impact of that same 65-day exponentially smooth moving average. Now here you can see that moving average coming along here. And if I go to this place here, just before this collapse occurred as a result of the Viceroy report, you can see here that the exponentially smooth moving average was 59 Rand 56, just before that report came out. Now today, some months later, that same exponentially smooth moving average is down to 13 Rand 93. So it has fallen significantly. It's fallen to 1/3 of where it was. You can see the share price has more or less stayed at the same level. Maybe gone down slightly, but it really has stayed at more or less the same level. But the EMA has come down and down and down and down and down. And eventually, if this share breaks on the upside, it will break through that exponentially smooth moving average at a virtually perfect point for the private investor to get back in. Because you don't know what's going on behind closed doors. You don't know. We never know. We only know what's in the public domain, what's printed in the Business Day or on the internet, and that's all the information we can get. But the insiders, they know the things that we don't know, and they will start to buy this share again if and when it represents good value. And that could be 3 months from now. But if it's still at these kind of levels in 3 months, you can believe that exponentially smooth moving average will be very, very close to the share price. Very close indeed. And you won't be paying much more than the 5 odd Rand that the share is trading for now. Okay, the next share I'd like to look at is Cartrack. Now, I don't know if this is a share that you've ever looked at or followed. It's a small company, but I think it's an interesting company. Just going to put 5 years on the screen here. So there we go, Cartrack. What's interesting about it is this, obviously, this dramatic upward trend that you can see on the right-hand side of your screen. Now, Cartrack is in vehicle security and recovery. So they put tracking devices into your vehicle, and they have apparently a 93% recovery rate on vehicles that they are covering, which they have to go and find. 93%. They operate in Africa, in Europe, in Asia, and in America. Now they've started to do something very interesting. Based on this 93% recovery rate, they're now offering a theft-only insurance policy for, get this, 10 Rand a month. Under 10 Rand a month. They are prepared to insure your vehicle only for theft for less than 10 Rand a month. Now I think that's got to be a winner in South Africa certainly, and probably in other parts of the world. The share price, as I pointed out just now, has gone up 80% in the last year. And this is obviously because it's a very nice kind of business. Their income is a debit order business. They've got thousands of people who've got debit orders on their bank account, sending them money every month, and that gives them very steady growth. Also, they've been growing their market all over the world. So I think that this is a very interesting company and one that you should possibly be looking at. Now I'd like to quickly look at Tiger. I know I've been a long time here, so I don't want to exhaust you. But Tiger Oats, very interesting things are going on there. And I think it's definitely worth your attention. Now I want to draw attention first of all to this significant head and shoulders formation here. Can you see it? There it is, the left shoulder, the head, the right shoulder, and of course through the middle here we've got what is called a neckline. And you'll see that it broke down through the neckline there where my mouse is. And that was on the 21st of February this year. It broke down through that neckline. And then of course it came out with its results, which were pretty dismal. They were not good. And immediately following that, the listeriosis outbreak was directly linked to two of its factories and to the Enterprise brand of processed meats. Now I think that this is a very interesting situation, because you would have got out of the share had you seen this head and shoulders formation and the breakdown over here through the neckline. If you'd seen that, you'd have been out of the share on the 21st of February at about 42 Rand. The share has now fallen all the way down to 40 Rand, and it looks like it'll fall further. The big problem with this listeriosis outbreak is that 180 people have died. There is definitely an opening here for a class action lawsuit against Tiger, and God knows how much that will cost, but it could be a fortune. The point is that long before listeriosis was connected to Tiger, you got a clear technical analysis signal to get out of the share. And once again, I point out to you that people on the inside know things. Maybe somebody inside Tiger knew what was going to happen, and they used that information, they traded in the market, and they can't hide the movement of the price from you though. So you can pick up insider trading by watching the market and following major formations like this head and shoulders formation. Then I'd like to talk to you finally about Glencore. Glencore is an interesting company because it's a mining house. Just want to wait for it to come back there. Glencore, there it is. Put a bit more data on the screen here for you. Now, this share has been going up very strongly, and there's good reason, because it's obviously in commodities and mining all over the world. It's an international group, but it is listed on the Johannesburg Stock Exchange. What I want to draw your attention to is that this company has got very big mining resources of copper, cobalt, and nickel. And those are the three minerals which are needed for battery technology these days. And battery technology is set to gain sharply from the spread of electric vehicles throughout the world. So, a study done by Glencore recently, by an independent company but paid for by Glencore, shows that if 30% of vehicles on the road by the year 2030 are electric, then this will require 4 million tons more of copper than is currently being produced, 1 million tons more of nickel, and 300,000 tons more of cobalt. And Glencore has got all those minerals. So if you're talking about a company that will benefit from the advent of electric motor vehicles, Glencore is an international company that will benefit directly. So you need to make your own decision about that. Ladies and gentlemen, I've been talking for a long time and I don't want to bore you. There is, of course, much more in the notes, and I would strongly advise you to go and take a look at those notes and read through them carefully to get all the different points. Otherwise, we remain open for questions, and I'd just like to thank you very much for listening to me. And remember, the first Wednesday of next month of April, I will be back here to talk to you again, and there will be another confidential report. Thank you.